Hey guys, this is Reggie with Stock Talk. I want to go over a strategy I use to actually get paid to do a debit spread. So that's right, a debit spread, not a credit spread, a debit spread. So this is a screenshot from my Etrade account. I bought a JP Morgan share on earnings, right? They're going through earnings. And so JP Morgan, this is the leg that I bought and this is the leg that I sold, right? So I bought a $139 call at 199 and then went one up and sold a 140 call for $2.18, which is a debit spread, right? Now, but I got credited $19. I got paid. Instead of paying, I got paid for this move. And if it expires in the money, I get $100, right? Because I only bought one contract each. I get $100. So this can make me $120 if it expires in the money, right? If it doesn't, and they both expire worthless, I've made $20. I got you know for nothing, not even risking my money, just for the move. I got $20, and it's just okay, cool. And it didn't work out. Usually, you get zero, right? You lose your money if it doesn't work out. So yeah, that's nice. And if or if this thing, if one expire, like if the one I bought expires in the money, and this one doesn't, then I would just sell this one right away. But it's still not a big deal, right? So let me show you how I did that. Let's go to the chart. So here, right, I bought, so I'm gonna get rid of this so we can see. All right, so it won't delete for me. Don't delete it. Bear with me, guys, sorry. So what I basically do is I watch the chart pattern, and with the chart pattern, I will, especially I start seeing it fluctuating. So here, let me zoom in a little bit. And so it was fluctuating. And so I'll wait for it to fluctuate as they sometimes do. Oh my goodness, this is a disaster. I'm sorry. Hey, let me get this together. All right, sorry about that. So here we go. If you look here, so right around this candle, right around this range, I bought it when it hit 139, right? And then it kind of no, it was right around here. So it was this candlestick here. So it was fluctuating, and it came over. So it found support here, and it was at 139. I bought it in the money. It was just got in the money, and then it fluctuated up, right? And as it went up, it hit 140, and then I sold the other leg. So instead of buying and selling both legs at the same time, and some accounts will let you do that. It'll just show you the spread difference. I bought one leg, so I bought the 139 call here, waited for it to gap up, right? Because you want to buy cheap. So you buy it before. So my target price is this to be above 140, right? So I bought it here, and I said, okay, so I bought it at 139. You buy it cheap, but you have to buy it quick, right? Because you can't let it go for a whole day. I mean, sometimes you can, but sometimes the volatility will change on you, and even though it's up, it'll be worth a little less. But you buy here, and then when the gap up, it got close to 140, it hit 140. I sold that 140 contract, giving me a credit, right? Now, I could have risked it and went a little longer and waited, but I didn't want to risk this thing going down on me. And then I would have been selling, it'd cost me more. So I'm just happy as long as I I'm in the green. So that's how that works. So I basically bought it low. I bought the one leg, the buy leg low, and then once waiting for the gap up and sold the sold leg higher. It was worth more. So you just gotta watch it fluctuate. So that's how I did it. So if this doesn't make any sense and I'm not explaining this well, feel free to comment below and I can explain it a different way if you have any questions. But that's how it works. And obviously, it takes some knowledge of uh, debit and credit spreads to even have the slightest idea what I'm talking about. So yep, so that's how I work. That's how I work, man. I got paid $18 to make a trade. And if on the 22nd, and right now we're well in the money, but if on the 22nd it dips and dives, like, well, it looks like it did dip and dive. Hang on, let's go to the beginning. Okay, so yeah, as of today, it's out of the money. So, but we still have a long way to the 22nd. So if on the 22nd it's in the money, I'll make $100, right? I make $120 total. If it's out of the money, I lose nothing. I got $20 for my efforts, which usually in trading that doesn't happen. You either make money or you lose money, right? So that's how it works. This is Reggie with Stock Talk. Don't forget to like and subscribe so you can stay notified of all my different videos. I am a swing trader. I look at a lot of stocks every day, and when I find little gems, I do share them. This is just a strategy that I'm sharing. So, but I do like to drop gems when I find good chart patterns and good technical analysis on a stock that may be moving up. All right, this is Reggie with Stock Talk. See you on the next one.